Hello and welcome to our Global Investment Outlook for 2025. A year of divergence lies ahead in growth, inflation, central bank policies, and investment opportunities. The global economy should keep expanding. Many central banks, including the Federal Reserve, should keep lowering interest rates as inflation falls to target. But a second Trump administration will set the US apart. It's a high-octane diet for the US economy. Growth should be spurred by tax cuts, deregulation, and infrastructure spending, a slower pace of expansion than in 2024, but still above potential. Of course, tariffs will be, to some extent, inflationary and limit the Federal Reserve's ability to cut interest rates below 4%. But outside the US, the main impact of tariffs will be to weaken growth. The Eurozone economy could therefore remain lackluster. Can US policies be a catalyst for a change? For now, we see little prospects of reversing weak investment and productivity. Even a new German government is unlikely to release materially the brakes on fiscal policy, while France faces political instability. Monetary policy can only do so much, but the European Central Bank can at least keep cutting rates more deeply than the Fed. China's authorities now have two major challenges: stabilizing the property market and offsetting the negative impact of US policies. More stimulus is likely. Some currency depreciation might be a solution, but could hurt domestic demand and disrupt markets. Without such radical policies, we see growth slowing further. Emerging markets will also be challenged by US tariffs and a strong dollar. Yet, fundamentals in many economies have improved, helping to limit stresses. Of course, there are many risks to this outlook, not least the volatility of US policies and its implications for interest rates and debt sustainability. China's attempts to revive trade and its domestic market could disappoint once again. And of course, geopolitics remain a prominent risk, centered around US-China tensions and conflicts in the Middle East and Ukraine. So, how are we preparing our portfolios? Well, let's turn to Michael to find out.
Profound change is on the way in 2025. In a multipolar world, investors need to prudently manage risks and seize opportunities. New US policies will continue to create more market volatility. We are entering 2025 with higher risk exposure in portfolios. That's because we see another constructive year ahead for equities, although perhaps not as outstanding as in 2024. America First policies will of course benefit US assets. Despite high valuations, US stocks should gain from deregulation, lower taxes, falling interest rates, and solid growth, and we retain our overweight exposures here. We also expect Japanese stocks to perform well, supported by improving growth and corporate reforms. In fixed income, our overall allocations stand at strategic levels. We favor corporate bonds where investors can benefit from high yields. Default risks look contained. Rising public debt, particularly in the US, supports this preference for corporate over sovereign bonds. Within sovereign bonds, we like German bonds and UK gilts. These should benefit from more interest rate cuts than markets currently expect. In currency markets, we see the US dollar as a key beneficiary of the new Trump administration. It should stay strong thanks to demand for US assets and higher interest rates than in other advanced economies. Later in the year, markets may focus more on the impact of tariffs. We would then expect haven currencies like the Swiss franc and Japanese yen to be more supported. We also expect gold prices to stay high in 2025 despite the strong dollar. Haven investment flows should add to demand from central banks. In portfolios, gold can also act as a hedge against geopolitical risks. Finally, alternative assets have a more important role in multi-asset portfolios. Hedge funds, real estate, and private assets can all extend the range of potential investment returns. With US policies in the driving seat and a multipolar world, it is time to anchor portfolios in solid, transparent assets. By staying vigilant and actively steering portfolios, we will take advantage of the investment opportunities that are sure to materialize next year. We wish you a happy, healthy, and successful 2025. Thank you for watching.